Institutional algorithms and retail traders monitor the exact same charts and order flows, yet professional wealth consistently accumulates while retail portfolios routinely shatter. This divergence originates from a phenomenon known as the wealth trap. Even when a strategy is sound, execution is often sabotaged by hardwired psychological blind spots that dictate behavior under pressure. While institutions possess superior capital and technology, a mastered behavioral edge serves as a vital equalizer. It allows a disciplined investor to remain rational when the broader market defaults to panic. Exposure to these biological impulses often determines whether an investor retains their capital or surrenders it to market volatility. To protect your portfolio, you have to override the very instincts that feel most natural. Our methodology relies on quantitative institutional data from Morgan Stanley, prioritizing measurable evidence over gut feelings or sensational headlines. This research focuses on behavioral finance, the study of how systematic cognitive biases influence market movements and individual decision-making. The human brain is naturally wired for financial failure. Under stress, our neural connection points prioritize immediate emotional relief over long-term mathematical probability. Identifying and overriding these specific biological biases is a primary requirement for stopping the systematic drain of capital into institutional accounts. Institutional findings quantify the high cost of emotional reactivity. Over a 30-year timeframe, poor market timing imposes a severe, permanent penalty on a portfolio's overall total value. This chart displays a balanced portfolio tied to the S&P 500, generating an 8.8% average annual return over 3 decades. The average retail investor captured only 4.8%. Through the power of compounding, that behavioral shortfall results in $840,000 in lost wealth. Frequent emotional trading provides a sense of control, yet it functions as a mechanism for transferring nearly $1 million of potential wealth into institutional hands. Recency bias explains much of this behavior. This cognitive error tricks the brain into assuming that the current market environment, whether a vertical rally or a crash, will continue indefinitely. This chart of the March 2020 crash illustrates the danger. Recency bias convinced many that the freefall was permanent, prompting them to sell at the absolute bottom when fear reached its peak. This panic is amplified by herd mentality. When investors see a crowd moving in one direction, they often abandon their own data to follow the crowd, assuming there is safety in large numbers. The combination of these biases leads to extreme capital loss. The 2021 meme stock cycle serves as a perfect example, where investors followed the herd into vertical rallies only to hold through the inevitable collapse. In the markets, following the emotional crowd is a high-risk strategy. Comfort in numbers frequently precedes a financial trap. Confirmation bias acts as a defense mechanism once a trade is executed. It causes the brain to filter out any information that contradicts the initial decision. This manifests when an investor actively seeks out bullish commentary while ignoring earnings misses or negative macro data that would otherwise signal a need to exit. This bias is dangerous because it neutralizes logical risk management. Investors often hold losing positions far too long, simply to avoid the psychological pain of admitting an error. Modern digital environments now weaponize this bias. Social media algorithms feed users content they already agree with, creating echo chambers that reinforce existing beliefs and hide contradictory evidence. Without the strict discipline to actively seek out and respect opposing data, an investor is essentially trading blindfolded. An isolated, emotionally trapped trader reacts to the noise of the market. On the other side of that transaction is a systematic investor who benefits from that lack of discipline. Long-term success requires a holistic, systematic plan. A professional strategy is designed to harvest the capital left behind by the panicked herd. Review your own trading history and tell us in the comments which cognitive bias has cost you the most money over the years. Subscribe, like, and share this video to receive weekly data-backed stock analysis in your feed. Joining the smart money depends on continuous education and the ability to override basic human instincts. Stay disciplined. The host of this channel is not a SEBI-registered investment advisor. The information and analysis provided here are for educational purposes only and do not constitute financial advice. Conduct independent research or consult a certified professional prior to making any financial decisions.